Welcome everyone to the closing bell. Jason Jacoby here with the ever so famous Mark Boyer.
Mark Boyer.
Mark Boyer.
Yeah, I was wondering if I should change my name, Boyer. What do you think?
No, I like
Nah,
I like
never
Boyer.
mind. We'll keep it the way it is.
Yep, we like it. We like it. But we thought we'd do something a little bit different, right? We're calling a little audible for football terms. Gonna walk through the newsletter and show some visual charts and give you our thoughtful opinion on all things market, economics, things of that nature, today's news, and of course we got to sprinkle a little bit of sports, right?
Might as well. It's the best time of the year. You got football and you got baseball playoffs coming up. Pretty good. So that's exciting.
And soccer, obviously. But yeah. So let's dive in. So what we'll do is we'll share our screen, and again, you can digest this in podcast form. We'll have an audio only version, video, or you can just read the newsletter, and then be on the lookout for some Instagram clips with some real good, wisdom that might not be time restricted on this, but obviously with Instagram we'll be able to post it on there. So anyway, let's dive in and we'll get it going here. So I'll share my screen and pull up our newsletter and we'll kind of walk through it. Again, we called an audible. We thought this might be a little bit more fun and entertaining and engaging, and maybe we'll even live stream it on social platforms in the future. So that being said, it's been quite a month so far, hasn't it?
September, yeah. I mean, basically September is not a historic great month for stocks. I mean, it's just not a lot of news out there and so forth. And I think, back to school, back to away from vacations, people are, just discouraged or whatever. But shows traditionally, September doesn't end up being a great month. So you can kind of expect that coming into the fall. But this one's a little bit, especially we'll talk about what happened this week, a little bit more significant news than maybe other Septembers are in regards to interest rates and so forth. But yeah, not surprised.
Absolutely. So why don't we dive in? So a lot happened this week. Obviously, Fed paused rate hikes, but we've been hearing the concept quite often about soft landings. So recession, are we gonna have a recession? Are we in one? Is it a rolling recession? Which we talked about that being quite an educated guess for us. Obviously, different sectors experiencing contractionary periods in different times, meaning rolling recession. But let's talk about the concept and what brings about a soft landing and the risks associated with it. So we kind of talk about that in this week's newsletter, right? We've got these 4 topics right here. If you can see my mouse, we've got overly aggressive monetary policy. So, Mark, why don't you touch on that a little bit? So what would that mean for the economy moving forward? How would that allude to a soft landing or not having a soft landing?
Yeah, so I mean, I think one of the things you got to keep in mind is soft landings. I've read something here recently that talked about soft landings are total lucky anyway. I mean, the reality is that very seldom we talk about soft landings, and yet it's seldom that it actually happens. But it's always a hopeful event that's going to happen for us. And so soft landings are the idea of when you're putting pressure on the economy with, like in this case, raising interest rates. The Fed's been doing that for the last 16, 18 months and significantly. And so hoping that that'll slow down the economy to get us to a place where, we will hit a recession, but maybe it'll be a small one. And, maybe we even roll, like we said, a rolling recession, we roll out of it. But so what can upstage a potential soft landing is, like number one, aggressive monetary policy. And that's what we heard this week. It's the idea of the Fed really hitting in raising interest rates at a significant level to where they have a tendency to overshoot. And it's really an interesting phenomenon because, and this is typically, so even this week, Powell comes out and talks about the numbers, and they're choosing to pause again for this month of September, but he said that they might have one more rate hike before the end of the year, and based on the what all the numbers that are out and what they're looking at, so the history shows that the Fed has a tendency to overshoot, and they're too aggressive. And so that's kind of the question. And what's interesting is, and one of the reasons that happens is because they're looking at they're looking at numbers that are coming in that are always a month or 2, 3 months behind where the current economy is. So they're looking at, backward numbers, trying to shoot for the what's going on in the future. And that's a really challenging environment, especially when you throw in what happened here with the banks this year. And, it takes interest rates, quite a while to roll through an economy. So, we're not getting up to date, like real time numbers on any of it. It's always, we're looking back 2, 3 months. So it's a hard deal. And so that's why I think that a lot of times the Fed can be overly aggressive for too long.
Great points. Great points you brought up. And obviously, to coincide with that, another rearing head that could affect a soft landing, right? Could be accelerated economic growth. If things kind of take off so quickly, we get some really robust growth. That can disrupt a soft landing, because then that obviously means if there's economic growth, if wage pressures again kind of rear its head, to use the same words, spending power, right? I mean, stimulating the economy, which increases inflation. So if we get that too quickly, that could put effect onto it as well. And then coinciding with inflation is, what's the biggest part of that inflation?
Well, it's energy, right? I mean, everything, fossil fuels are a mainstay of our economy. You can try to pretend that's not a fact. You can force people to buy EV car. I mean, there's lots of things that are happening in our economy right now, in our government. But the reality is, fossil fuel and the price of gas and fuel to run cars, to companies, everybody uses it across the country and around the world. So when you have higher gas prices, and it affects everything, and that's an inflation component that my opinion, we are not helping ourselves, especially in the U.S. And we're not, we're limiting drilling, and we're not using our own natural resources. So it's really unfortunate with the current administration doing that. It's something that's just going to be there. It doesn't look like in the near term it's going to change a whole lot. Because we've used a lot of our reserves, and we got a long ways to go and catching back up on the energy price. So we're over 90 now, and a lot of people are looking at $100 to $105 price, for oil. So that's going to be interesting to see how that plays out. But that's another thing that can cause a problem with a soft landing.
Yeah, I definitely think if we get oil above 100, I think that's kind of baked into the cake already.
Yeah, it looks like it.
Especially with OPEC and Russia cutting exports, is basically dropping supply, and demand still going to be high. So it's not looking good for oil prices. I think oil companies at some point too, because it's at some point, if it starts tapering demand, those oil companies are going to lose profits as well, because they're just not getting the demand that they would attract. A healthy $60 to $80 a barrel even might even be more attractive than another $20 at 100. So I think balancing that supply and demand, right, and keeping that price as steady as possible will help all industry in the U.S. and abroad. So,
I was going to say, there's just two ways. Again, we talked about this before, but there's two ways to impact prices, and one is, it's the old price, and prices come as supply and demand. So you either provide more supply, or you try to reduce demand. So currently, what we're doing here in the U.S. is trying to reduce demand by increasing prices and interest rates. So that's how it happens, and then couple that with the fact that you reduce supply at the same time you're, it's just, it's not a great scenario for energy prices, so we're just back to some prices that we saw a couple of years ago, and we'll see how it plays out. It just takes time for the economy to adjust. But it can, like we're talking about, can affect a soft landing scenario.
Yeah, absolutely. And then last but not least, just on this list here, just checking it off. You already had kind of mentioned it: financial crisis, market crash, or bank collapse, which we actually had. The Fed just backstopped it super quickly, so it kind of prevented the cracks from going further. However, going back to the higher interest rates, right? We got a lot of commercial loans coming due. So obviously, with higher delinquencies in that and defaults on those loans, obviously people aren't going back to the office as quickly or as much as expected. So you have more office space, you have less people filling those commercial spaces. Commercial real estate is taking a pretty big, pretty substantial hit so far, correct?
Yeah, I mean that's been a big. There's a lot of empty buildings still, and a lot of leases that are due. So commercial real estate's really struggling. And I think in New York and Chicago, you hear all these places where there's just got
Yep.
huge vacancy levels, and so that cuts into profits. And so I know they're filling some of them up in New York with homeless and all good stuff, but it doesn't pay the bills, and these loans come due, and it gets challenging because now new loans and refinancing is much higher and more expensive than it was. So again, yeah, another area that just takes a while to play itself out, which leads to
Mm-hmm.
what we're talking about in regards to being too tight for too long.
Yep.
It's a real hindrance to potential soft landings.
Absolutely. So these are just some of the charts that we just talked about. Obviously, Wall Street Journal articles referencing a soft landing, quite high the last 2 quarters here, which is kind of interesting. And then obviously looking at oil prices. I mean, look at the futures prices here, quite
Yeah.
striking. I mean, look where we were. This is just this year too. I mean, starting at around 85, $87 a barrel, and now we're up again, edging closer to that $100 a barrel. Global's a little bit higher because they rely so much more on foreign oil, foreign gas than we do. But still, I mean, the delta isn't that much of a difference, a couple of dollars per barrel. So
Yeah, it makes a big difference. I mean, this is a shorter term chart here. It's only a year or so, right? So I mean, it looks pretty dramatic. And again, but if you roll that out a few years, we've been here before. It's not like we haven't. But again, for the sake of what we're talking about in regards to interest rates and so forth, it's going to put pressure on the Fed because these numbers all play into the inflation numbers that we get
yep.
on each month and each quarter. So it'll just say that inflation is going to be higher for longer. And we've been saying that, and so it's
Yeah.
these numbers keep kind of just reiterating the fact.
Good points. Good points. Well, I don't want to touch on this too much. I mean, it's kind of self-explanatory. We talk an awful lot about jobs, initial jobless claims, just slightly above 200,000. Continuing claims fell below one, or is still below 1.7, which is that psychological indicator of kind of when things start to look a little bit softer in the job market. So still really tight labor market. However, it's pretty interesting. The U.S. government has accounted for quite a large portion of jobs filled in the public sector here. Prior to it only accounted for 5% of employment growth over a given time frame, but they've added over 327,000 positions in the first 8 months alone here this year. Obviously, a lot of public servants, police officers, teachers have retired or left their job during COVID for various reasons. So they're trying to make their jobs more attractive, obviously having to increase pay, provide other perks to try to stimulate people coming out of that private sector, maybe into the public sector, public servant type of field. So just wanted to touch on that. I found that quite interesting this week. Obviously interesting to see kind of where the jobs flow through the market. And obviously during summer, you get services and hospitality, restaurants, things of that nature in that service sector that really kind of stand out, but should cool down a little bit, hopefully here in the next month or two. And then obviously holidays, right? I
Yeah.
mean, I think Amazon's hiring a couple 100,000 as well for
Yeah.
holiday.
I mean, so these are interesting numbers, and maybe it's seasonal. I don't really know. I just know that long term, U.S. government jobs are not going to keep the economy moving the way we need it to move. I'm not saying that it's great for people that have government jobs because it's an opportunity, but you need the private sector to be hiring, and and again, that's where it's just we need that for longer term growth of the economy. You need that area to be participating in the growth too. So it might be a seasonal thing in here right now, but we'll keep an eye on those numbers.
Absolutely. Absolutely. Just want to show the chart wasn't showing up here on the PDF. So I'm going to pull up the actual newsletter because I really want to hammer home this next point on our newsletter for this week here. So bear with me 1 second. All right. Here we go. I'll share my screen again. And if you're listening to this, again, the charts just show exactly what we're talking about. So you're not missing out on much, just the visual representation of it. So we're going to look at this here. Okay. You see that?
See it. Yep.
Perfect.
We're
All
up.
right. See if we can zoom in a little bit, maybe. Okay. So this one, again, is just talking about the public sector jobs as a comparison to payroll gains. A lot higher.
Can you make it bigger somehow? Jason, can it get larger or no?
Let's see.
There we go. Bigger. Perfect.
Oh,
a little better.
Too big.
There we go. Nice. All right.
Okay. And then we're going to scroll down here again, just showing change in employment from February 2020. Obviously drops off quite a bit. Federal hired quite a bit. And then obviously it's tapered off. Private sector is still leading the way in change of employment. But
yeah.
All right. So the global energy war, I found this quite interesting as well. So gas exports, talking about natural gas, right, which powers a lot of heating, cooling, a lot of other things around the world. So, everyone used to think Russia, largest exporter of natural gas. Well, we've actually had some change to that because of what's going on with Russia, Ukraine, obviously adding some restrictions on Russia and their exports. People just aren't buying as much. Norway's actually come to the front as of recently. So it's kind of reshaping the energy landscape. We talked about supply and demand, crude oil, Brent oil as well, which is made in the UK. And then obviously natural gas is kind of the other big one. And you look at some of these other names that have kind of, popped their head up quite substantially, trying to pick up where Russia kind of left off. So we got kind of quite a bit of a fallback with Russia. The gold, again, is this year comparative to last year. So obviously a lot of money that Russia is losing due to the Russia-Ukraine war.
Yeah, I mean, we go back to when the pipeline was blown up by, still they haven't figured out who did that. I have my ideas, but the reality is that, that forced the UK and European, the Union, that area, to really try to find other ways to heat their fireplaces and their, or their heaters and everything else that they use, cooking and so forth with natural gas. So yeah, it's good. That's actually good news that they're actually, importing from other countries now. And for those countries, that's great that they get a bigger slice of that pie. Great.
Absolutely.
Actually, great news.
Yep, absolutely. So we talked briefly about the Fed pausing here, but why don't we just give a quick history lesson of what's kind of happened here comparative to last rate hikes? I mean, you've gone through quite a few of these, actually all of these on this chart here. Shows how seasoned you are, right? In a good way.
Yeah. I was listening to a guy talk about, he's been doing it for like 40 years and he's been through 23 down markets. So, it was interesting. And the good news is this shall not last. He made a great comments. This shall not last. So anytime we have negative markets and so forth, the good news is that they don't last forever. And part of investing. Anyway, that's a separate subject. So sorry, I digress.
No. That's good advice, though. That's good advice. We always say patient investors win the day, and obviously patience over all of those down markets over those 40 years, because they happen, are going to win the day if you can ride those out. But just in terms of rate hikes, obviously Powell came out, said they're going to be data driven, paused rate hikes. I think we're pricing in one more 25 basis point rate hike here between now and the end of the year. And then hopefully they just stop. Hopefully, I mean, we already said that months ago. We hope they stop. They haven't, but pauses are good. At least they're not going higher at this point. Obviously, depending on data moving forward. But I mean, if you see this chart, I mean, if you look at this, I mean, 2022, look at that steep curve.
Wow.
Going to the moon there comparative to previous, rate increases, 1999, 2015, 94, 88, and 04. So it's quite interesting, don't you think?
Yeah, I mean it's unprecedented the rate at which we've increased rates the last couple of years here, and it's and I think that's why a lot of there's a lot of talk about what it means and how it's going to play out. Nobody knows. I mean, the reality is nobody really knows when you've increased rates that fast. So we're sort of in unprecedented territory. We talked about a rolling recession. You talked about, like I said, this week we've got news that, they're actually, they're going to pause here and maybe one more before the end of the year. And then, maybe two
Yep.
cuts next year, which was
Yep.
sort of a shock to the, markets really, because they talked about more cuts. And the other interesting thing is that for June next year on the 10-year, they had the dot plot, they call it, with that the Fed looks at, which is what all the different Federal Reserve people think about where interest rates are going to be, and they had in the last meeting projected around a 4.6% in next June, but now they're at like 5.1. So it's
Wow.
significantly higher, and that's where I think the markets, and you see the 10-year, which I'll show here in a little bit, but that's the market just doesn't know what's going to happen with how fast we've raised these rates. So yeah, I've been through these before. This one's different. I think again, my good news is that every time that they've raised rates, you can live in a higher rate environment.
Hmm.
Anybody who lived through this late 70s and 80s knows that. My first house in 1985, my first mortgage rate was 12.5%. I mean, can you imagine that right now? You can't even fathom what that is,
Nope.
but houses were still going up in price and so forth. So it can happen. It's just a matter of an adjustment. And so the whole economy has to adjust to higher rates. And that's what we're trying to figure out right now. And that's what the markets are trying to come to grips with, is how much higher for longer. We've been talking about higher for longer.
Yep.
And, the 2% target, it's going to be hard for the Fed to get to that. And, so we've been reiterating 3-4%, that 4% is sort of the long 100-year average.
Yeah.
And that's probably where we're going to end up, so anyway, that's what's happening there. It's really an interesting kind of fun time to be a part and to be alive, to kind of see how this all plays out, especially in
Yeah.
our economy right now.
And you're so right. I mean, the economy can function in a higher rate environment. So people don't need to think that for those investors that are newer, right, or are newer in home ownership or whatever it may be, when they got rates of 2.6, 2.8% during COVID, thinking that's the norm. I mean, like you said, your rate was what, 12 and a half, you
12
said?
and 12 and a half. Yeah, 12
Yeah.
and a half. And that was good. We felt like we were getting a deal at the time.
Yep.
No, seriously. I mean, because you could get CD rates for, I mean, they were north of that as well.
Yeah.
So I mean, the good news at higher rates is you can get higher, money, higher rates back on your money too, right? In safe instruments. But again, it takes a time for an adjustment, and we're coming out of historic low rates that everybody, we're not going to see those. We probably never see those low rates again
Nope.
in our lifetime. And it's just not, probably not going to happen unless we have actually disasters that happens. I mean, it would be, to get back down there, it would be significant. Some significant event would create
Yeah.
that kind of scenario, but which is
Yep.
possible. But again, probably not in our lifetime. That what I'd say.
Good point.
So we're going to get to a place where normalized yields are sort of the norm, hopefully, and hopefully they are the norm, and we don't get
Yeah.
too high again too fast. So that's what's the markets are kind of dealing with right now.
Absolutely. Okay, so markets in review. A challenging week. It's been a challenging month. September usually sees outflows. I mean, you kind of get the summer slumber. Everyone's kind of out vacationing, not really paying too much attention. Volume may be a little bit lower overall historically, but you're now looking at it. I mean, we're having a nice little sell-off. S&P index, has had its worst performance since March, leading to a 3-month low. So, obviously attributed to everything we've talked about, rising yields on the 10-year treasury, which will show in Mark's technical think tank here coming up
Yeah. So
next.
let's take a look at that. Let me share my screen now. See if we can do that. We'll get to this. I wanted to show the S&P 500. Can you see that? All right.
Yes.
Yeah,
Yep.
so this is the S&P 500 on a daily chart. Each of these little graphs here along the way is each a day. Okay, it's a
Yep.
day trading in the S&P. So we see that we hit a high here, 4607 on July 27th.
Mhm.
Um, and we had a nice run off the bottom of last October when rates actually hit this rate this level before was last year, and so we've had this kind of stair step up here and then pull back, and we hit a low. We actually pulled back on in middle of August to to right about 4,300 or so, 43. Yeah, right to that, and then bounced again. Didn't get back to the high, which again is yeah, not concerning, but on a technical standpoint, when you roll over off a not meeting the next high and then you hit lower lows, it's a challenge. So yesterday after Powell talked on this day, which was Wednesday, and then the next day the market digested all the things he talked about, and we ended up
Yep.
kind of down, pretty gap down, the S&P gap down, and then we're into Friday, and we're pretty much trying to hold that. And you'll see that, when you look at that number, if you go back a ways here, you'll see that, if you go, let me draw a line here. Well, you can see, I don't know if you can see my line there, but we're just seeing some right down in here. You're going to get some support, this low right here, and that's where the market, see this low right here on June 23rd, and then now we're kind of right on that line. So we're kind of at a inflection point. Just looking at the market, see if it can hold that 4,300 kind of level. And then the other one that's interesting is looking at, and I want to show the 10-year Treasury. This is the 10-year. This is a graph of the 10-year Treasuries, and this is the interest rates. You see that interest rates peaked last year in 2022 in October, which was a low in the market. And then we hit that again here, roughly that same area. And then this year, you actually see that in the last 2 days, we've
Mhm.
actually popped up above it. So that just means that the interest rates have gone up. That's an inverse relationship to fixed income. So bond prices go down when interest rates rise. But as again, you're getting higher interest rates as it keeps going. If you go to a weekly chart, you just see that. Let me go to a monthly chart. Basically, here you see that we've been here before back in. This is in 07, 08. That's why you're hearing everybody talk about we haven't had this higher rate since the 2000s, and that's actually a case. You can see it here in the market. And this is what we were just talking about. This big drop here was when interest rates dropped so much lower in 20 through COVID, and then again mortgage rates, everything was so low, but we're probably not going to see that time again. So anyway, it's interesting to look at it. I wanted to show that to you to see kind of how that's playing out, and we have to see longer term how that if this stays up here, probably has a tendency to go a little bit higher. We'll just have to watch those 10-year treasuries. That'll be, and that's what the market is concerned about, because when interest rates are higher, you have it's a negative to the growth aspects and future
Yep.
earnings of growth companies. So that's kind of one of the issues.
Absolutely. Cuts into their earnings, like you said, and higher cost to do business and borrow. And, it's the forever economic web that is weaved and goes around and around in a circle
Yeah.
sometimes. So it's really interesting. Those are all really good points. And just to kind of end out the video here, just, as we go back to markets and review, again, sectors declined. All major market sectors in the US were in the red this week. Consumer discretionary materials experienced the largest declines. And then obviously US government debt. So that's actually on track for its third consecutive year of losses, as expectations of a rapid pivot by the Fed have receded. So obviously people thought that they'd start cutting rates this year immediately. We never thought so. Higher for longer is the theme. We still believe that as well. And what's really interesting though, especially in September here. So I want to talk about fund outflows. So global equity funds which include US equity funds, by the way, so it's global, it's not just international, it's global, saw significant outflows, highest since December of 2022. So obviously people have, been a little bit pessimistic about it. I think it was over 18 or 19 billion this past month in some of those. So
And
quite a,
Jason,
yep.
you said that's the highest outflow since December of 22.
Yeah.
Okay.
Yep.
Yeah. So yeah, it's interesting though. But let me just make this point that the December 22 was actually the last coming out of the last low in the market. Um, and I will just make this point. Uh, no offense to anybody out there, but typically the average investor is making the wrong play at the wrong, is doing the wrong thing at the wrong time. We see that in all kinds of studies regarding the emotional aspects of investing. Um, it hurts a lot more to lose money than it feels good to make money
Yep.
emotionally. And so when people get afraid, they start cashing out really quick. And so I almost see that as, and my point is this, I see that as a contrarian indicator. I actually like to see the fact that people are bailing on equity. It's actually, it sounds really creepy. It probably weird, but it's that's actually a really good sign. It's a contrarian sign that's real positive for investors.
Good points. No, great points. So, I mean, that's the last thing I wanted to kind of touch on. That is obviously we've had a lot of outflows. We've got over $5.6 trillion sitting in just cash, just
Yeah,
money market accounts right now.
that's
So that'll
huge.
that'll flow back into bonds, then back into equities at some point. So once people get a little bit of FOMO and the fear of missing out, then
Yeah,
it could be off to the races. Again, we're not market timers or short term investors. We have the long term mentality and mindset, but just to keep that in mind, there's trillions of dollars. There's over 19 trillion actually sitting in money market and short term debt instruments as well. So
yeah,
lots of money out there.
and that's good. I mean, and rightfully so. Interest rates are higher now, so you can actually
Yep.
get safer money. That's one of the things that is good for us as investors because you can actually park your cash in something that's going to at least get you something.
Right.
Where 2 years ago we got nothing, right? There was
Yep.
no interest to be made. So that's a really positive sign. Um, and I just want to make the point here on our call when I show you charts and looking at the near term negative aspects. It's not just we're not traders. We're not trying to say it's time to get out of everything. It's to reiterate the fact that you need to have a balanced portfolio. What if anything down markets do for investors? It should make look at your portfolio and just make sure you're positioned right with cash, 3 to 6 months of living expenses. You got enough fixed income that 5 years worth of income if you need it. It kind of
Yep.
and then beyond that, even in the volatility, stocks still long term have always shown to be better places for growth than cash. And if you wait for the bottom line is if we wait for when we feel like it's the best time to get back in, you've missed a significant part of the rally already because you're not going to
Yep.
feel good about it until it's moved up quite a bit. And so that's why you just got to stay really disciplined, keep your emotions out of it, and stick to a balanced portfolio that's well diversified and set up for your actual income, that fits your personality and for your income needs and future
Yeah.
needs.
Absolutely. And I really thought this was interesting too. So people think about, oh, I'm getting 5% on a CD, which we talked with one of our investment companies that we use about recently, about how, okay, so let's say you put in, 100,000 into a 3 month CD, you're getting 5% approximately. Obviously, you're getting more than that right now, but just for round number purposes, right? You're getting 5%. Everyone's like, "Oh, I'm making 5% of my money," which is great, which is true. You're actually, putting your money to work, which is what we tell you. But once you factor in taxes on a CD on the gains, once you factor in inflation, which is sitting around 4% right now, you're basically at zero. But the flip side of that is, well, at the bank, you're getting 0.1% or 0.2%. So instead of losing money, you're actually just you're staying afloat, right? So even when stormy waters, which it tends to be right now, you're still floating there. You're still positioning yourself to have cash, and that's keeping pace with inflation. And so in the end, achieving the goals. It's putting your cash to work and making sure it's available when you need it.
Yeah, and yeah. So you want to have that enough of that for you to handle any near term expenses that you have, for sure, no doubt about it. And that's the positive thing of all of this is that we're getting higher yields. But to your point, it's like, yeah, we're getting 4%, in our money market funds, or 5. I mean, over
Yeah.
5, which is great, but inflation is still ramped up there. So you're just keeping pace with the purchasing power of the dollar. So
Exactly.
um,
Exactly.
that's but that's better than sticking it under your mattress. So
Yeah.
let me make that point, because some people just like, I'm going to be in cash. I don't care. I don't want to. I'm afraid. And your fear is actually causing you to guarantee you're losing money
Right.
daily. So
Exactly.
you got to step out a little bit in the minimally. You got to get it. You got to at least be in the game. We talk about that a lot, right?
Yep.
I shared recently at an event, that we hosted, that just I was watching the Jets, and that's where I played for 3 years of my 8-year NFL career, and it was fun to watch them on TV and look, hear them Jets, Jets, and I, a lot of memories came back and watching the pregame and all that, and anyway, it's just, one of the challenges for any athlete is even though they're ready and they feel like they're positioned to be successful, it
Yeah.
still takes courage
Yep.
to cross that white line when the game starts in front of, in that case, you got 70,000 people or whatever watching, plus a TV audience. It's like, it takes a lot. It takes courage to step out there and kind of make yourself vulnerable. And
Absolutely.
but there's nothing better than being in that game. There's nothing better and more, and in regards to your career, it's super fun. It's like, hey, I gotta, I don't want to play. I'm scared, but you got to get in play, and you got to have a balanced portfolio. You got to have a diversified offensive and
Approach. Yep.
defensive,
Yeah.
game plan. And so you got to go out
Yep.
and play. So it's fun, and that's what. And I love, one of my favorite scriptures in the Bible is in Ecclesiastes chapter 11, where Solomon, who was considered at the time has been one of the wisest men who ever lived, he said, "Look at, cast your bread on the waters." In other words, his point was, get in the game. You got to get in, divide it between 7 and 8,
Yep.
diversify and get in the game,
Yep.
and stay after it. So anyway, it's just really important. I think even with all the stuff that's going on, that's what's happening with all that cash on the sidelines. Is it's due to, a lot of that's due to fear, and we can't live our lives in fear. We gotta
Yep.
get in the game and have some fun.
Good point. Good point. I love it. I love it. Well, we'll end it right there. We hope you guys enjoyed this first podcast edition of the Closing Bell. Again, newsletter. We work hard at it. Again, we really want to be thoughtful in our approach to investing and financial planning. We care a lot about our clients, so it's always good to provide information and empower and educate our investors. Right. That's the thing.
Yeah, we love the people we work with, and it's fun to be a part of this. Thanks, Jason, for putting this together. You do a good job with that.
Thank you. No, thanks for all your wisdom, and it's fun working with you. And we'll be back next week with another edition of the Closing Bell. See you then.
Thanks, Jason.
See ya.